Ever wondered how much money you're leaving on the table by not investing in real estate? Today, we're diving deep into numbers and, most importantly, helping you figure out what kind of investor you really are. Because staring at doom and gloom charts won't make you a better investor. Knowing yourself and understanding the kind of investments you want to make will. In fact, we'll even take a look at some of those charts to see if they can actually help us or if they're just financial horror stories. Let's face it, the first step to not screwing yourself over in the market is actually knowing who you are in it. Okay, now that you're thinking about who you are in this game, let's talk about one of the biggest traps you could fall into: timing the market. Buying at the peak feels like a bad move, but let's get real. If you're in it for years, today's peak could be tomorrow's bargain. While you're waiting for the stars to align, you're missing out on solid deals. So, today we clear the air and get straight to what signs to look for to figure out if the housing market is too hot to handle or just right. Let's take a worst-case scenario. Imagine you bought a house at the peak of the market in 2007 for $257,000. You're the guy with the worst timing in history, alright? But you rent it out and get a 4% yield every year. Then comes 2020, the start of the COVID-19 pandemic. You panic, thinking the world is ending and home prices will plummet. So you sell at the lowest point in March or April, getting $360,000 for it. Now, even in this doomsday pandemic-fueled scenario, here's the kicker. You would have still made $236,000, combining both the appreciation of the home and the rental income you earned. So, the next time you're biting your nails, waiting for the perfect time to invest, remember, sometimes good enough is perfect. Let's get to the point. What's really important when you're thinking about buying a house? You might be looking at fancy charts or worrying about rising prices. But here's a question. If you're thinking about buying a place in your own city, what's the first thing you'd look for? A safe neighborhood or just going for the cheapest price? The answer you pick could turn your investment into a win or a costly mistake. So, let's dive deeper. The golden rule in real estate? Location, location, location. Honestly, that's a rule of thumb that stood the test of time. To mess this up, you'd really have to go out of your way. Now, aside from location, there are some other basics you should focus on. 1. The yield or return you'll get from your investment. 2. Whether the monthly rent you can realistically get for a house in that area will cover the mortgage, not the dream numbers your agent might tell you. 3. The type of neighbors you'll have. Are they difficult, noisy, or otherwise problematic? So, when you're buying property for investment, you don't need to be a chart wizard. Just focus on the basics. Get a place that'll give you a decent return, lock in a mortgage rate that won't strangle you, and aim for neighbors who won't scare off your tenants. The next time you see YouTube headlines screaming, "Don't buy now," or "Wait until year X, the market will crash," take a step back and think about your end game. Are you in it for the long haul, or are you looking for a quick flip? Understand that quick flips are essentially gambles, loaded with risk. They're not really real estate investments, they're more like speculations. And let me tell you, that's not what we're talking about here when we aim to build wealth through real estate. Alright, let's talk about some examples of what you really shouldn't do. Don't just go buying a house in a place you don't know, even if it's cheap. First, pick a place you're cool with and that you know well. Watch that area, make sure it's a place where you'd actually want to live. Unless you want neighbors who act like pirates, and trust me, you don't. Ignoring due diligence. Don't skip the inspection or the background checks on tenants. These steps may seem bothersome, but skipping them can lead to costly mistakes. Sure, there are more pitfalls to avoid, but these two are some good examples. They show that it's not just about price. There's so much more to think about when investing in real estate. Believe me, you'll lose a lot more money by not checking all the legal paperwork or picking a sketchy neighborhood than you ever will by buying at an all-time high. Imagine you did wait for the perfect moment and caught a 33% price drop, like the one in 2009 compared to 2007's peak. Sounds great, right? But here's the catch. You can lose that advantage and then some by making poor investment choices based on the wrong criteria we've just discussed. What if you chose a bad location, had to deal with tenants from hell, or skipped the home inspection only to find out the property needs major repairs? Suddenly, that 33% saving turns into a money pit, wiping out any advantage you gained from timing the market just right. It's like snagging a bargain on a 4K TV during a Black Friday sale, only to realize you need to upgrade your entire home theater system to actually enjoy it. The deal suddenly isn't so great anymore. Or consider this. What if that low price you snagged is actually a mirage? You might have bought the house for less than its cost a year ago, but if your rental yield doesn't even keep pace with average inflation, you're essentially losing money in slow motion. So instead of fixating on trying to buy at the lowest price, focus on things you can actually control. Like, does the investment give you a good yield? If it does, even if the price is at an all-time high, you know you're making a sound decision. If the yield is bad, then it's a no-go, regardless of how low the price might be. A property is not cheap just because it is lower than the general housing market price or because it is lower than peak prices. A property is really a business if it gives you a high rental return. To make the investment worth it, you should aim for a return of at least 4% so that you beat the average annual inflation rate of around 3%. Remember, it's about making smart choices, not just cheap ones. Don't get lost in the price game and focus on the real profit that a certain property could offer you. In other words, don't just stare at the market trends. Zoom in on that one property you're eyeing. Calculate your potential gains and don't just go by rosy scenarios, plan for the rainy days too. This is just like the stock market. Even when the Vanguard Index is soaring, there are individual stocks that can be gold mines for you. Take a look at this clip here to find out why the real estate market hasn't collapsed yet.